Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 20 minutes here on Options Guy TV. All right. So on Friday, I forgot to look at a COF trade, but the stock did not cooperate with our outlook. So I'll just show it because I don't want to act like I'm avoiding it. We're going to look at a trade in BA today too, because they're going to be announcing earnings. And then we got Microsoft and Meta announcing on Wednesday. We got long a Meta trade already. Well, at least we talked about it. So in this instance here, they announced earnings, and I'm going to zoom in on the area. The 200-day is actually kind of interesting. We came down almost, bumped up to it here, bumped up to it here, but it seems like it's had solid support through there. We were kind of hoping that the downturn in the stock was more so from news out of Washington, but they disappointed on earnings, and the stock is down. So our butterfly did not pan out. That simple. We have, I also talked about a long call spread, and that trade's not looking too awesome either. It's not looking good whatsoever. And that the market's at 220 right now. We bought the 237.50. So at this point in time, it's worth a quarter. If you wanted to get out, you could have got out a little bit earlier. We had a little bit of time premium left in it, but right now the stock doesn't look like it really wants to bounce, and I don't really see it. I mean, I think the next stopping point is its 200-day moving average. It's provided an area of support. If we go through here, yeah, we're a little bit below even this trend line, if you will, right here. So I do think that if we're going to get some support, it would be around the 213 level in the underlying stock. Right now it's at 220. Hopefully, maybe you'll get a little bit of a bounce, but I'm not interested in getting long Capital One Financial for the long term. I really was hoping that based off of that the stock was down based off of the news, and a solid bounce back might have happened after that. But it looks like the news is still dragging it down, and that's where we're at. All right, so let's go in and look at Boeing today. Symbol is BA. The chart is very interesting in Boeing, and it's considered a defense stock. I guess you could say that. And part of the so because of this, we've had this strong move to the upside. Boeing's a lot more volatile than it used to be over the last year or so. Because of their trials and tribulations, we're keeping their planes in the air actually to start with, but a couple of other things too, including a couple of rocket ships that weren't working as well as they once thought. So with that move, we got another strong move to the upside. And this looks a little overdone in that we're heading into the earnings report. It's going to be tomorrow on the open. I want to say on the open. Yep, it's on the open. And so I want to get bearish. So let's get bearish. We haven't gotten bearish on an earnings report in quite some time. So we'll look at two different ways of doing it. We'll do our butterfly, our standard butterfly to the downside. You got 4 days remaining though, because so you're going to have all day Tuesday, all day Wednesday, all day Thursday, all day Friday. It's a $250 stock. Time decay isn't going to erode very quickly on it, so that changes things. If we're doing zero DTE options, right? If we're like Amazon always announces on a Thursday, and all you have is 1 day for the option contracts to live on if you do the Friday expiration. Here we got a few more days. So you need time decay to erode quickly in order for butterflies to pay out. If you're correct on your forecast, you want time value to go away because you've sold 2 at the money option contracts. By opening the wing though, we're kind of okay with that in that we have an upside if the market blows through the strikes to the downside. So I'm going to start with that trade. We're going to go a little bit out of the money. It's a little bit more expensive to do it with puts because your your way out of the money put option is going to be inflated, mainly because of volatility skew. And what usually happens is out of the money puts trade for higher valuations than out of the money calls. It's a normal thing to happen, and that's going to be happening here in our option contracts. And I can highlight that just by looking at where the volatility is. So if you go, here's the 20 delta option, about one standard deviation out of the money, right? That's trading for a 54% implied volatility. If we go over here and we look at, once again, right where it's highlighted, a 20 delta option, you're trading at a 53% implied volatility. And 1 percentage point, especially on a $250 stock, it's worth it can be costly in that instance. So because of this, we're looking at paying up a little bit more for our butterfly, but let's do it in anyways here. So we got earnings tomorrow morning. I think we're going to try to go 5 points wide here. Let's go from 245. So right now we're in the earnings. We're looking 4 days out, January 3rd, January 30th expiration. If we look at the expected move, it's $5 plus $5. So this is 6 and 5. We'll call it 11 and a half bucks to the downside, about 11 and a half. So that puts you down right at 239 or 238.50. That would be the expected move. The one standard deviation move is down to about 235. So within this range here, within the darkened colors of the options grid, and this is one of the things I like about the options grid, is that it will highlight the one standard deviation move. Makes it very easy to pick strikes. So we're going to buy the 245. We're going to sell 2 of the 240s. And then we're going to buy 1 of the 237.50s. So in this instance, we're paying 108 for it. And I'm going to send this to the what if calculator. And if we go anywhere below our lowest strike, the butterfly has to trade for 250. That's what the number is. So below 237.50, which is the lowest strike of our put butterfly, we have a long put spread, which is $5, and then we have a tight put spread on the short side that is paying for the long put spread, that is 2.5. 5 minus 2.5 means that this has to trade for at least $2.5 anywhere below that strike. Now we're paying 108 for it, so that means our max upside is going to be 142. 140. Yeah, that's the green line. Okay, so 142. If we pay 108, which now it's 98. Let's make it $1. Let's say that we can execute our trade for $1. And if we can trade for this dollar here, then we got $1.50, and that's the maximum we can make on the trade. So if we get it executed for $1, we're within the one standard deviation move. We've had this huge run up in Boeing just because the whole area of defensive stocks has kind of ran up. And so because of that, it's pulled Boeing along with it. We're going into earnings. We'll see, earnings is a good reason to sell a stock off like this. So even if they beat on the top and bottom line, if they just do the normal, there's an opportunity to take some profit. So because of that, here is the first paper trade that we're going to look at on Boeing, is a long butterfly heading into their earnings report. All right. So that's stock number 1 that I want to look at. Now, the next stock, the next trade that I would maybe think about doing in Boeing, and I don't necessarily like to do this around earnings, but I don't mind selling an out of the money call spread in this instance. So we're going to look at this, And there's a couple of ways that we can treat it. If you want to get bearish, you go a short call spread would get bearish. A short put spread would get bullish. So we're going to look at going about 1 standard deviation move out of the money, looking at the 265 strike, and then buying the 270. So we're going to sell this one, and we're going to buy this one. And we can get this 5-point wide spread done for a net credit of 49 cents to the account. Now, don't mind doing that trade if you are bearish on Boeing, but I kind of like the concept of the skip strike butterfly as an alternative. So the first outlook would be to do the open wing butterfly, getting it done for a very decent valuation, $1 for the potential to make $2.50 or to make $1.50. You're risking $1 to make $1.50. If it lands right on the middle strike, you can get paid $5, which means your max upside would be $4. So I like that trade. There's nothing wrong with it. I just don't like the fact that we have 4 days until expiration. So if it does land on the middle strike, it's going to take a while to get paid. And that's the only headache here, as opposed to having even if they announced on a Wednesday as opposed to a Tuesday before the open. You have 4 complete trading days until the expiration of these option contracts. Okay, so if we're here and we're looking at a skip strike butterfly, and the normal butterfly is trading for 49 cents, let's look at skipping the 255 and 275 and buying the 280. And we're going to sell. Let's flip this around. We did the 272. Okay, so if we do this, we got to be selling the 265. So we are going to, let's try this, sell that twice, skip that, and buy that. Not quite a net credit. It's not it's showing that we can get it done for even. Our requirement would be 2.5 on this. I want to get that done for about a quarter. I don't know if the market moved. It should have been about a quarter. All right, let's clear it out. I'm froze. 1 second. I did my own COF. It didn't work for me either. Okay, Kurt. Hey, good morning, Kurt, by the way. Thanks for joining. Yeah, the COF didn't work out, but quite a few in a row. We had quite a few butterflies in a row around earnings that did work out. I don't mind the Boeing trade, and it really is the chart in Boeing. I mean, strong draw, look at this drive up in Boeing and down. Look at this type of volatility. It's amazing the volatility that's in Boeing, and this strong move up and a potential move back down, and they're just solid moves to the downside. So you kind of look at this and you say, all right, well, this is a move that might have been around earnings the last time around, but these are the type of moves. So maybe you don't want to do the skip strike because you're risking 1 to make 1.5. Maybe we do something a little bit long term. I don't like the skip strike on the with the calls because we're not getting enough of a credit. But let's go and look at this. So maybe we buy the 250 and we'll stay here. Well, maybe let's look at this going out 11 days. So $5. We're at 250. We're still going to be paying $5. And we buy this, and we sell the 1 standard deviation move. This, because you can get some premium on the downside. Like I said, you're selling higher vol 1 standard deviation out on this trade than you would if you were looking at the call side of things. It's still not wonderful in that the break even is going to be 247.50 minus that 375. but you're giving yourself a lot more upside in this scenario. The maximum you can make if the market goes down is 875. And in this instance, the maximum you can lose is 375. So you still need that expected move to the downside for this to be a strong move. But this might be one instance where if you look at the chart and you see the volatility that this underlying has had around recent news events, around recent earnings events, maybe you want to take a shot and get a little bit more on the downside than just the open wing butterfly. And it's still got to turn out. They still have to obviously underperform in their earnings, or their earnings has to be perceived as bad. They could beat on the top and bottom line. You could still see the stock sell off though with Boeing. So that's where I'm at. I'm going to look one more time at the skip strike, and maybe if we go out 11 days, let's see where that's at. So if we did the short spread, let's look at selling the 2650 and going 5 points and buying this one. Okay, so that's still 50 cents. And we're on the February 11th. So this might be tough. Okay, so if we did the skip strike butterfly, let's start from the beginning. We would buy this one, sell 2 of these, skip, and buy this one. Yeah, it's still even. I don't like it. Yeah, I don't like it. It just didn't pan out. I'd want this to be at least 25 cents if we were doing this trade, and we're not getting that. So we're getting it done for even. I'm not looking for it to go up. I would, if I was going to do it, then I would just sell the short spread here. Sell that one and buy this one and bring in that net credit of 48 cents. So that's one way to get short, is to just do the short call spread. I don't like the skip strike because we can't get it done for a net credit. I like the open wing butterfly. And if you are feeling a little frisky, you look at doing just the long put spread. And I think I have let's go back to the what if calculator. So here's the long put spread. And I'll send that to the trade ticket. And we'll look at both of these. I'll save both of these. And then we'll also look at the long butterfly, and we'll send that to the ticket too. And that's 99 cents right now. I like it at $1. I like that trade at $1. Just $1 worth of risk versus $3.75 worth of risk on this one. 364 right now. We'll call it 370. I'll make that the official paper trade. 370 right there. Yeah. Maybe I underestimated the risk of the potential capping of credit card interest rates. I really thought that would kind of wean a little bit once some of the CEOs opined on the thought of it, but maybe that's weighing down the credit card companies still at this point in time. JP Morgan isn't doing that well either, and that has a little bit to do with that too. Goldman Sachs is flat, so Goldman Sachs was better out of the two investment banking firms, but at this point in time, that's where we're at. All right, I don't have much more for you today. Any questions or anything that you would like me to cover, or anything that we've done recently that we could cover? We'll go. I'm still in the paper trading account. So I do have the Meta trade. I did actually throw that in here. Meta's going to be announcing earnings this week, Wednesday after the close. So I do have the 655, 720 that I put in, and we'll watch that. And then we have our Netflix trade that we sold the short option against, and the FedEx trade. The FedEx trade is still hanging in there. down a little bit on FedEx, but our call option that we sold is up about 25%. But it's only, we sold it for $1. It's trading for 80. We're 106, and the midpoint is 80 cents right now. The only there is the JP Morgan. We're still hanging in here. I don't want to sell a call against it, but we're down 45% on it. So if we hit the 290 strike, we want to get out of JP Morgan. That's always been our rule. And the other way to look at it is if we're down 50% on the trade, we want to get out of that stock too. So I'm not happy with that because ideally I really wanted to do Goldman Sachs, but I still thought JP Morgan had a lot more upside. But once again, I think that the news out of Washington is hurting it a little more than I anticipated. And we're at 290 on it. And right now it's at 300 is where JP Morgan is at. JPM. There it is, 299.92. So I would have an alert. And if it hit 290, I'm definitely going to get out of the trade. And if it goes down 50%, you could say that we're going to get out of the trade. And that's our rule. That's the way that we work it. And then we just move on, and I would find another financial stock that I would want to own. Schwab still looks good too. SCHW. Yeah, they're up today too. Well, I think JP Morgan is up too, right? Yeah. So the financial sector is doing all right. Let's look at the Schwab chart. Yeah, it's hanging in there. It's hanging in there, doing a lot better than a few of the other financials. But we're still, we got the Fed meeting this week. It's highly anticipated that nothing's going to happen this week, but interest rates in general in the short term are going down, and in the long term they're staying steady, which is a good situation for most banks. You have that inverted yield curve, which is a good thing overall. All right, I guess that's it. We'll see you on Wednesday. We'll look at another trade in Meta, and we'll also look at a trade in Microsoft on Wednesday. And then we have Apple earnings on Thursday and Visa. Visa should be interesting too. Caterpillar Thursday morning. So we got the bulk of the companies are going to be announcing this week. This could possibly be, especially in this quarter, the most news heavy week possible when you throw in the Fed. So thanks for stopping in, and we'll see you Wednesday for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.